30 on, 30 off, 15 days on, 15 days off, something like that. And we would always count the day done as soon as we woke up. It's not the way I like to do it, but it's the way the industry did it. So as soon as you woke up Friday morning, Friday was done. We have a lot of Fed speakers today. Yeah, I'm feeling a little better. I got up early enough to take my meds and let them kick in, so it's not as painful. All right, this morning the morning briefing is called Thought Bombs. With all these Fed speakers, it will only take one, right? Just one to screw up, say the wrong thing, for that wrong thing to be misrepresented by the press, and then that would be market moving for sure. All right, so as you can see on FX Street in the economic calendar, all these different speeches, they're not dark orange, but they do have potential impact. So we want to be aware of those different times. The news out of Japan wasn't that bad. Remember yesterday we had a lot of economic stuff on the table. And then coming in next week, first thing Monday, we've got those auctions. The front end auctions. But today it's all these different Fed speakers and European Central Bank as well. The rig count isn't anticipated to be impactful at all. Should be no big deal on that. So we can see you 0-day traders, be careful this afternoon. The rig count isn't a big deal, but you got Fed miser at 140. So you want to be a little mindful of your 0-day trades when you got a Fed speaker sitting there ready to move the market. all in all, it wasn't a bad week. The markets were able to hold their ground, let their moving averages get caught up. No massive sell-off. We can see the volume sitting at around 101. That's comfortably normal. If it was really light, we'd be concerned. If it was really heavy, we'd be concerned. But as long as we know why it's light or why it's heavy, then it's not a big deal. Sitting at around 100 is our typical normal. So we just get it out of the way at that point. We don't have an MDP because we ran through it. We are below the 10. That'd be the 10-day. So we've got through it. Yesterday came back above it, wasn't able to keep it, went back down below it. Now we're working on getting back above it again. We're just going to continue to flirt with it. If you look at it here on the daily, kind of get a better idea. All right, it's that blue line. So we're crossing back and forth through that blue line. We are inside day, and although yesterday doesn't really feel very wide, there's a lot of trash there. And for us to get a really good day today, we've got to get outside of yesterday's boundaries. Now, if you're losing more often than you win, one of the things you can do is just quit trying to do the hard stuff. And one of the things that we classify as being harder is trading inside of yesterday's price action. So, don't misunderstand me. I'm not saying you can't trade if we're inside of yesterday's price, but I am telling you it's going to be more difficult. And if you're already struggling, quit doing the hard stuff. Pretty simple. Trade the edges, trade the breakouts, and if we don't get one, then you don't trade. Of course, nobody wants to hear that. As a psychologist, I keep track of different studies and material that comes out. There's a study that says people would rather lose, but tried. They'd rather do that than not try and sit and wait for a good setup. They'd rather just trade a bad one and lose just so they can participate. Doesn't make a lot of sense to me, but hey, to each their own. Psychology doesn't have to make sense, right? Ten-day, 30-minute volume profile. When we're at the low, we expect to go to the high. When we're at the high, we expect to go to the low. We're flirting around with that point of control again. Now it's above us. It's not support and it's not resistance, but it will be difficult to get through that area, right? Think about what that point of control represents. It's where the greatest amount of trades took place. It's the greatest amount of volume took place. In blue on the right side, we can see the TPO. That's time, price, opportunity. It looks very similar to a volume profile, but it's not a volume profile per se. It's volume by time rather than volume by price, which is a volume profile is volume by price. So TPO tells us how long we stayed at that particular spot, and volume profile tells us how much was traded at that particular spot. They're lined up perfectly. So when we go back to that 44.15, there's an expectation of unfinished business. More work to be done there. More transactions are going to happen there. That can develop into resistance, or if we manage to get through it, it can act as a support just because of the actions that are taking place, not because we'd look at that line and say, oh, well, it's a point of control, it's support or resistance. It's not. The 5x5, 5-day, 5-minute chart, volume profile on each day individually, carrying forward the point of control if it has not been hit. All right, now when you get into using a volume profile, the books can tell you about carrying forward these lines. So if we zoomed in on yesterday and we were learning how to use a volume profile, the book would say, well, carry forward this value area high, the point of control, and the value area low, and shoot them into today's price. Then whenever price revisits that area, we'll have that reaction. I don't do that, but I'm not saying they're wrong, right? I've already got enough pivots. I don't need any more. So I don't do that. The only one I carry forward is the point of control, as long as it hasn't been hit yet. So back here, for an example, the day ended, and the next day, price had not yet hit that point of control, and still has not hit that point of control. So I leave that line there until we do finally hit it. VPOC stands for Virgin Point of Control. It's untouched. I'm not the one that made the names for these things, so, hey, it can't be any worse than dead cats bouncing. There's an image for you. All right, so we talk about this weekly expected move from time to time. It was developed, this particular indicator was developed by Mobius strictly for the S&Ps, strictly for the SPX. But we use it everywhere, so it's not like you can't use it anywhere else. But the reason that he even made it in the first place is because there was an individual drawing them by hand every week. And of course, if you wanted to see it for Facebook on Wednesday and you didn't draw it last Friday, well, then too late. So Mobius created this. It's okay. It's nice when, you're going to be looking at a lot of markets, but you're better off doing it by hand if you're only going to apply it to one market over and over, because the code on Thinkorswim can't access the data that it truly needs. What it's trying to give you is this expected move here. Got a new pin, so I'll try to 5 days out. It's trying to give you that expected move right there, that 45.92. But on Thinkorswim, you can't code anything that can reach this data here. So he did the best he could, and most of the time it's really close enough. But if you wanted to do it by hand, after 4:15 on Friday, you would get the lines, do the calculations, and put them on the chart. The reason I bring all of that up is we're flirting with the low today, and it's not I don't want to say it's the wrong one, but it's not as accurate as if you had drawn it by hand, right? So don't look at that line down there and say, oh, well, we're hitting the line, so it should bounce here, right? Or it should turn. It's going to close inside that box 80% of the time, because the line could be a point higher than where you're looking at it, or it could be a point lower. So, it's not an exact science. We're not trying to get these things down to the tick. It's a $4,400 product. 1 or 2 ticks, come on, man, one way or the other. Either way, keep in mind that we do close inside the box about 80% of the time. So when we don't close outside of the box, it becomes a little important. We closed outside of the box last week. Right, so there's the line in the sand. Yeah. And we closed up there. One week doesn't mean anything in the grand scheme of things. It's repeated weeks that we want to watch out for. So, a while back we had nearly an unprecedented number of closes inside the range in a sequential format, right? So like we did it last week, we did it the next week, the next week, the next week, the next week, the next week. And there was so many in a row that we actually set a new record on how many weeks in a row we closed inside the box. Then we finally expanded out of that range and we began to move. We had one back here, 519, where we closed outside the box. Then there's another one here where it's an argument if we did or didn't because it's nearly on the line. And then here. So one thing that I like to do is count back over the last 10 weeks. 10's an easy round number, and you can use percentages after you're done. In the last 10 weeks, how many times have we closed outside the box? It's supposed to be 8 out of 10, maybe 7 out of 10. 7 out of 10 would be your 70%, your one standard deviation. But when you start getting more than that, then it's a warning. In February before COVID, when we were sitting at all-time highs in the market and we were grinding into these stratospheric levels right before COVID, we failed to close inside the box repeatedly, back to back to back. It was a big warning. It was a big heads up. And while we didn't know we were going to get some COVID style crash, a lot of us reduced our position sizes and a lot of things and, just kind of started cleaning house. I picked up some really cheap VIX trades back then because there was just too many weeks in a row that we were closing outside of the box, and it was telling us something's going on here and that there's a looming threat. So last week it was just 1 week. This week it might be the second week. We got to see how today goes. But if we do close outside the box again this week, it's implying that volatility is picking up. That's one. And that the market makers aren't pricing it into the chain. And that's two. The VIX hit like an all new low yesterday. Right? It's crazy low right now, below 13.5. And yet volatility is picking up. And we know that it is because volatility is a fancy nerd word for movement. And when we have volatility, the market moves. We moved enough to get outside the box. So we want to see how the week ends, obviously. We want to see if we're going to close outside of this box or not, and recognize that if we do, that's week number 2 back to back. And that it's a tell. The volatility might not be warning us that there's something wrong, but these other tools can certainly warn us. Nice way to nerd out on you guys on a Friday. We do have a market maker move today of 0.33%. It's about $15. Added to the $50 expected move that we already have. And you're looking at about $65. That $65 would be just a normal day. If we're at 4,400, we're talking about 4,465 by the end of the day. And if you're thinking, come on, man, that's reaching. I haven't even begun to reach, right? That's nothing. If we thought today was going to get exciting, we would double that number at least. So then you'd be looking at 45 something. Or to the downside, 43.40. And if we were to really get wild, 42, something like 42.60 today. Now, most of the day is already done. I know that it's something that newer traders kind of give me the stink eye when I say that, but the day started last night at 6 o'clock. We're past 6 o'clock this morning. So more than 12 hours of the day is already done. For our trading day, there's not much time left. And if we're going to make a, say, a 1.5% move now from here, it's got to get up and go. It's got to do the thing. So it won't be subtle at this point, right? It won't be subtle, won't be sneaky. It'll just be a rip one way or the other. One level at a time, though. We got to get through the trash from yesterday. And even if we do that, there's still the weekly pivot point to the upside. And there's this snow line, it's a voodoo level, at 43.71 to the downside. So if we do break yesterday's low, 43.93, then our target is going to be that snow line, 43.70. Yeah, I didn't name it snow either. I didn't name these things. Just to remind you guys, I did a video on each of these columns, and then I shared the Thinkorswim script or code for these columns. That way, when you're doing the morning briefing, you've got the same thing. It's in the link to the YouTube video. All right, the KWeb constituents are down this morning 1.4. That's going to be your JD, Baba, Baidu, Neo, tying in with emerging markets right behind it. Emerging markets is mostly dominated by China names. And then we've got semiconductors down more than 0.75% as well. And they've been doing a lot of the heavy lifting. The unfortunate thing is I see KRE is also down this morning, nearly 0.75%. Now look, we got to have one or the other, right? If you're going to have a trend day, if you're going to have a bull day, you got to have one of the two main sectors, right? Well, there's three risk on sectors: consumer discretionary, finance, and technology. The consumer discretionary is like a piggyback. It normally just hops on whichever one is dominant. So if the tech is dominant to the upside, you'll get consumer discretionary jumping on that bandwagon. If finance is dominant, then that's where it goes. When you get all three running in the same direction, it's pretty awesome. But we've had this dichotomy or this split between financials and technology. Even yesterday, with that steep move to the downside in financials, if you look at what the NY Fang was doing, explosive move to the upside and just a grind higher to close at the highest point of the day. So today, both of these are actually moving in the same direction. Yay. But they're both moving to the downside. Ooh. So we want to keep our eye on these two for a split, see if they diverge and start going different directions again, or if they both turn to the upside, or if their downward descent increases, right? Watch the rate of change. I do have my homemade little Fang index here, and it's down more than 0.5%. For a capital rotation, we wouldn't want to see building materials, and yet we have those down as well. And energy and tech. So it's almost one of those mornings where it would have been faster if I had just said, what's up? Bonds, through the TLT and nat gas. That's it. We do have the Dixie up, or at least UUP. Let's look at the dollar on Thinkorswim and not over there. All right, so the dollar closed down here at about 102.5, and it made it above 3 this morning, but it's back inside that 102 zone. Same thing with the bonds. So bonds had a nice move to the upside, but we're still inside day at this point. We really want to keep our eye on those bonds, see if we're going to get a breakout above that 128.5. Now, the thing about bonds, they're still using the fractional measure, right? So half is 16 over 32. And no, they don't reduce anything, right? So it's not like you'd knock that down to its next lowest reduced fractions. They don't even bother with it. So it's just 128 and 16 over 32. If you look at that really nice flag on the ZB, the 30-year, it's a really nice inverse representation of what we have on the S&P. I'm pointing it out because there's been a lot of days recently where stocks and bonds are moving in the same direction together. So you'll have bonds up, stocks up, or the ES up. You'll have them both down. Right now, they're really nicely inverted. And we want to see if this sticks or if we lose it, right? And it starts to unravel. If it starts to unravel, they'll go back into a more correlated state again. All right, so the dollar's got a lot of work to do. Now that I'm on the higher time frame, you kind of see this trend line that it broke through. It's TRB. And now it's trying to work its way back up. As long as we're still inside this range, then there's really not an expectation of drama, right? It's not like, you know, that strong dollar kind of outlook. But if we get above that 104.5, maybe 105, then we're going to start having to worry about the consequences and the weight or the pressure of the dollar against the markets. Otherwise, if we're in this zone or in this range, the only other thing that we really got to be concerned of is really fast moves, because it might not be up into a 105 or a 106, but if it moves really fast, then it can still shake things loose and break things in the market. So that quick move that we saw earlier created a liquidity gap. It wouldn't surprise me if we come back down and close that before we do anything else. And the quote, anything else is probably staying bullish in that thing, right? At least so far, we're expecting this trend line break over to carry over, right? To continue through. Right, so really, I mean, everything on my list is negative or flat, because we need at least a 0.5% before we consider it's up or it's down. Bitcoin is more flat than moving, right? So something to consider is that we just go into the long weekend, or we come out of this long weekend and we go into the close today, just having held the line. There's still a lot of people not convinced that this rally is going to stick, right? They're continuing to say that we're in a bear market, that this is just a temporary bullish impulse in a bear market, and that we're going to go back to being in a bear market soon enough. If they raise rates again, it's going to be this unprecedented event, this historic event. It's a pretty big deal. But Powell has made it really clear that his legacy is something that he's really interested in maintaining. Not our monetary policy or anything like that, heaven forbid, no. Just his own name in the history books. And he made it really clear that he's going to conquer this 2% thing. Even if he has to break something, he's going to do it. With the data we got out of Europe yesterday, inflation's not under control on a global scale. And the Fed could still come out and hike. That's what the skip was all about. They reserved the right to increase the rates at still. But until then, after this really big run that we had from 38.50 up to 44.50, you got to anticipate some kind of digestion or pause, consolidation. And it needs to hold this level for a little bit so that it's healthy, right? If it just runs too far, too fast, it's not sustainable. It'll all collapse. But digesting here, holding this level, is a really healthy thing for the market to do. And if it does it, then the capacity to continue on is still there. So I measured last week's candle. %50% and 100%, and we're on a weekly. One of the things that we would want to see if we thought that this bullish impulse was going to continue would have been a pullback to the 50 before continuing on. And that would have just been that immediate bullish momentum. And we don't have that, right? Because we broke the 50. But we are still within last week's range. So with that in mind, the bullish impulse that got us up here might be done. That bullish momentum is over, but the trend is still intact. So the trend isn't broken yet. We don't want to get bared up in the accounts. At most, you want to go with a bearish neutral, right? Or a bullish neutral. Be very cautious of selling calls across those highs. With the VIX so cheap, the amount of money you're going to get for those calls is really cheap, and there's a lot of risk, right? So it's not my phrase, but I'll say it: the juice ain't worth the squeeze. But a short-term trade, right, just for the week, and today being Friday, it's not much of a week left. You could do 0-day calls up there, or you could do maybe next Friday up there. But just keep in mind, with the really low credit, the risk that you're going to take to sell calls up there just might not be worth it. But on the other hand, you don't want to buy any puts because we're not really expecting, we don't have any signal of a big sell-off. Until we break below this 43.48, we can't even really consider a good short. You can short across the highs if that suits you, right? You could short from up there, it'd be an LRE. or you can wait for it to break down and then you can short it, because that'd be another LRE, low risk entry. But otherwise, you don't really have a good short until we get that breakdown. For a longer term short, we'd have to break the trend line, which I don't have drawn here, but so we got a long ways to go if you're looking for shorts, and we got some work to do if you're looking for longs. Either way, it's kind of a gift that we got right now that we're sitting inside of this range, because now it's a real simple play. All you got to do is wait for it to get out of the range. If you want to trade without confirmation, then buy into weakness, buy along the lows, or sell into strength, sell across those highs, rather than waiting for the breakout. I thought maybe there was some Apple news this morning for that gap, but not really seeing much. It had some MacBook news this morning, but that wouldn't have been enough. Well, they're really proud of that MacBook Pro. Oh boy. All right, so when it comes to TRBs, the one that I pointed out on the S&P yesterday really kind of fizzled. We didn't get much out of it, but Apple had a really nice example of that TRB setup. The problem is it gave us what it owed. So it only owed us back to the top, and that's what we got out of it. Now the concern is that it's just going to dump right back off again. You're looking at it on the weekly, you can see it's still just really healthy, right? Apple is not done. For today, if Apple can get above 187.50, then we can get to 190. The way options work for a day trade or just for a short-term trade, you're better off getting the calls when we're still falling, because they haven't priced in the turn yet. So it always changes how you would trade a product when you think about the way the options are going to monetize. Apple breaking above that 187.5 for a long to 190 would be what price would have to do to kind of give you that signal that a long is valid. But if you wait until that point to buy the calls, you're getting the worst price on those calls that you could get, right? You'd be better off buying the calls when the market's still falling. Either way, for the next week, if you go long today and you don't want to mess with those 0-day options, then 192.5 would be your upside target. It'd be 100% of this pullback week. So that'd be your first target, not your last one, right? All right, Microsoft's in a much worse shape. With Microsoft, you got a long opportunity if we can get through the close of last week. That's 342.33. And then resistance at 352 or target. I guess it's 351. So about $9. You could shorten all that up with a smaller time frame. All right, this morning we closed at 339.71 and we're at 336.71. So we're down about $3, halfway down on this red, on this blue candle from yesterday. So starting early, you would want to go long, say on a breakout of yesterday, and then either add in or scale out at 342.33, focusing on that 351. I don't know why I'm not overly bullish, but instinctively I'm looking at bullish moves. Today, really the expectation is that we're going to maintain the range, go into the weekend, and then expand next week. That's the baseline. But that doesn't mean we can't, like yesterday, kind of wobble and stretch a little bit. It's what we've done all week. So when you're looking at OCR analysis, a higher open and a lower close, and then a lower close and a lower close, and then yesterday, a higher close. So it's starting the turn. We either get the base first and then it completes the turn, or we get a V bottom and it completes the turn. News, of course, can break this down and then we'll go to the 20, 42.91. But it would take news to do that, right? Not just regular price action. Right, the analysts were busy this morning. Looks like they hit the casinos, the cruise lines, the airlines, energy, and some retail too. All right, we want to kind of just wrap it up. We need the bonds to calm down. We want to watch close between stocks and bonds to see if they're going to resync or continue to widen out, doing more of the opposite of each other. We've got finance and tech both doing the same thing this morning. That needs to change. Or we want to watch for change. It doesn't need to change. Them both doing the same thing is a good thing. If they both remain bearish, we could really break down and expand lower. Oil and stocks are both doing the same thing today as well. So kind of lump them in together, right? We're starting to get a market that's beginning to synchronize. And it's when some of the biggest moves can happen. And after a lot of days where we haven't really made big moves, the market's building up energy to make a big move. Stocks moving opposite of bonds is common. It's normal. We've seen it, throughout history. It's like the old 60-40 kind of thing. So it's supposed to do that, but it hasn't been doing it very much lately. And when it has, it hasn't been very clean. Today, it's really clean. It's really sharp. It's in focus. And the correlation with the energy market and the S&P this morning is really clean. So yeah, I'd say we're coming into sync. And that while my base case today is that we're going to hold the line, go into the close with no big moves, just chopping sideways, keeping what we got. That's my base case argument. But with all these things beginning to synchronize and move in step, a big move is on the table. A breakout above 44.30 really does offer 44.55, 44.60 today. And a breakdown of yesterday's low, we could easily get to 4,300, 43.40, 43.50, easy. Everybody be careful, be safe, have a good weekend, and I'll see you all next week.